finance lecture. Okay, a tow truck shows up at 3 in the morning, drags your car out of a lot you swear you were allowed to park in. $240, cash only, no receipt. That means anything. You go online, you write a review. The review is one of, I don't know, maybe 400 reviews, all saying the same thing, same lot, same operator, same 3 in the morning, and nothing happens. Nothing ever happens. Why does nothing happen? No single person was harmed enough to sue. No class action lawyer is going to chase $240 tickets across an unsorted list of strangers. And the regulator who is supposed to care about this is, you have seen the building they work out of. You know what I am talking about. So here's the question I want to live in for the next 30 minutes. What if those 400 reviews were not reviews? What if they were shares in something, an entity, a pool? What if there were a broker layer, and I am being deliberate about that word, broker, the way Robinhood is a broker between a retail trader and the New York Stock Exchange? Because retail investing, as we understand it, did not exist until that broker layer existed. The same broker layer for legal claims has never been built. Not really. There have been attempts. There is a startup called Redress, sometimes Redress Legal, that is trying to build it. And what they are proposing, I want to be careful here because the first time I read the deck, I dismissed it, and then I spent a week thinking about it, and I realized I was wrong, which does not happen to me as often as it probably should. Stripped of the marketing language, the proposition is this. There is a reservoir of small harms in the American economy, each one too small to sue, collectively, in aggregate, worth, and I want to be careful with the number. I have seen estimates in the tens of billions of dollars annually, and I think the honest answer is nobody actually knows because nobody has built the instrument that would let us measure it. This reservoir currently dissipates into Yelp reviews and Reddit threads and gets nothing back. Redress is proposing to capture it, to turn the small harm into a documented, time-stamped, monetizable file that law firms can buy, that companies have to pay to suppress, and that consumers can collect on. Subscription model. $9 a month, give or take. You submit, you document, the platform aggregates, the pool grows. At some threshold, the pool itself becomes interesting to a plaintiff's firm in a way that no single complaint ever could. Let me put that differently. Imagine that every one-star review you have ever written was secretly a share certificate in a holding company whose only asset was a partially formed lawsuit. And imagine that holding company could go public, in a sense, the moment it accumulated enough plaintiffs. A digression, because I cannot help it. Years ago, it must have been 2011 or 2012, I was on a panel in Cambridge with a litigation funder from London. Bow tie, the whole thing. He told me something I have thought about probably once a week since. He said the American legal system has a price floor under bad behavior, and the floor is roughly the dollar value at which a contingency fee attorney will return a phone call. He said the number was around $4,000 in expected recovery per claimant, depending on the state. Anything below that floor is, in his words, structurally consequence-free. The person harmed cannot get a lawyer. The class is too diffuse to certify. The regulator does not care. The Better Business Bureau is a punchline, so the floor stays where it is, and the entire economic substrate underneath the floor is a free fire zone for anyone willing to operate there. Buy here, pay here lots, predatory towing, small lease scams, mobile home park rent hikes, storage unit auctions, the microeconomy of grift. He estimated, off the cuff, that the floor protects about $90 billion a year of marginal bad faith revenue in the United States. I have never been able to verify the number. I have also never been able to forget it. If redress works, that floor gets lowered, possibly to zero. That is the thesis. By the end of this, you're going to understand 5 things you almost certainly do not understand right now. 1, why the contingency fee system, which everyone treats as the great equalizer of American consumer law, is actually a filter that screens out roughly 95% of legitimate harms. 2, why third-party litigation funding, which is a roughly $13 billion industry that nobody outside of 3 law firms in Manhattan has heard of, has been waiting for exactly this kind of consumer-facing front end for 10 years. 3, why what redress is doing is, in regulatory terms, walking through a minefield that most lawyers will tell you cannot be walked through. 4, why it might actually work anyway. And 5, why, if it works, the second-order effects on small business behavior in this country are going to be something the National Federation of Independent Business is going to spend a lot of money trying to stop. This is the kind of analysis that does not show up in law reviews, not because anybody's hiding it. It is that the people who think clearly about this, the litigation funders, the senior partners at the plaintiffs' firms, the state attorneys general who quietly worry about it, they do not publish. They make decisions. And the decisions live in conversations that happen after the panels are over and the cameras are off. What I want to do for the next 30 minutes is bring those conversations into a room where they do not usually happen. One more frame before we get into the body. The reason this matters beyond the specific startup is that what redress is gesturing at is the birth of a new asset class. Not a metaphor, a literal new asset class. The legal claim, subclass action scale, has never been securitized at the bottom of the market. It has been securitized at the top, which we will get to. The bottom has been left alone. If it gets opened up, the implications run through small business behavior, through litigation finance, through insurance pricing, and through the political economy of how Americans relate to corporate harm. Stay with me. This is going to get strange. Here's the story you were told, probably in a high school civics class, possibly in an undergraduate consumer law elective if you were unlucky enough to take one. The story goes like this. The American legal system protects consumers through a layered defense. At the top, the Federal Trade Commission and the Consumer Financial Protection Bureau write rules. Below them, the state attorneys general enforce those rules. Below them, the courts hear class actions on behalf of large groups of harmed consumers. And as a kind of last resort safety net, the contingency fee system allows any individual to retain a lawyer without paying up front, because the lawyer takes a percentage of the recovery. The system, as the textbook tells it, has redundancy. If one layer fails, the next catches you. Okay, now let me tell you what is actually true. The Federal Trade Commission has, on a good day, roughly 1,200 employees. It oversees, give or take, 20 million American businesses. You do the arithmetic. The Consumer Financial Protection Bureau, which I have a particular interest in for reasons we will get to in a later section, was structurally hobbled within 4 years of being founded, depending on the administration. The state attorneys general, and look, I have friends in these offices. I'm not running them down. They pick cases the way a public defender picks cases, by triage, the ones that hit the press, the ones that play in the next election. The $240 tow ticket does not make the cut. It is not even close. That leaves class actions and contingency fees. And here is where the story you were told stops being roughly accurate and starts being actively misleading. The class action mechanism, since the Class Action Fairness Act of 2005 has been progressively narrowed by the courts. Walmart against Dukes in 2011, Comcast against Barron in 2013, Tyson Foods against Bua Fakeo in 2016. Each one tightened the standard for certification. Each one made it harder to certify a class of small harms with non-identical fact patterns. And the buy here, pay here lot in Tucson, the towing company in Phoenix, the apartment complex in Atlanta, they have non-identical fact patterns by definition. Every consumer interaction is bespoke, which means certification is, in practice, a nightmare. So class actions, as a tool, have been gradually detooled. They still exist for securities fraud, for big data breaches, for product liability against deep-pocketed defendants. They do not really exist for the kind of small distributed harm that redress is going after, which leaves contingency fees. And here is the part I find genuinely strange. Most people, including most lawyers, treat the contingency fee system as the great democratizing force in American law. Anyone can hire a lawyer regardless of wealth. The lawyer eats the risk. The lawyer gets a third of the recovery. The system, as Mark Galanter argued in a famous 1974 piece called Why the Haves Come Out Ahead, and Galanter is the scholar I keep coming back to here, his framework on repeat players versus one-shotters is, I think, the single most useful lens for understanding what redress is actually doing. The contingency system in Galanter's account looks egalitarian on the surface, but in practice operates as a filter. The lawyer only takes the case if the expected recovery, multiplied by the probability of success, exceeds the lawyer's cost of carrying the case, which means anything below roughly $4,000 in expected recovery is, statistically, abandoned. The lawyer says no, politely, possibly with a referral to a free legal aid clinic that has a 6-month wait list and a 40% rejection rate. And the consumer goes home. Let me put that more sharply. The contingency fee filter screens out, by some estimates, 90 to 95% of legitimate consumer harms. Not bad claims. Legitimate claims, documented harms with a clear bad actor. They are filtered out because the harm per claimant is too small to justify the legal work, which means the protective architecture you were taught about, the redundant layered defense, has a hole in it the size of the entire small claim consumer harm economy, and nobody has built the patch. I want to give you a concrete case. There is a company, and I am going to call it Company X because I do not want to get sued, that operates a chain of, let us say, automotive financing centers in the Sun Belt. Buy here, pay here lots. Sells used cars at marked up prices to subprime borrowers at 20-something% interest, sometimes higher, hides a GPS kill switch in the engine, and if you miss a payment by 3 days, the car shuts off in the middle of a Walmart parking lot. The pattern is documented. There are, last time I checked, something like 1,800 negative reviews across Yelp, Google, and Trustpilot. 1,800. Each one a small harm, each one too small to sue. The state attorney general has looked at it. The FTC has been petitioned. Nothing has moved. Why? Because the individual harm, even when the kill switch hit a customer on a freeway in Houston, which I have heard happened, was settled quietly out of court for an undisclosed sum and a non-disclosure agreement, and then it disappeared. The harm is real. The accountability mechanism cannot reach it. A digression. I taught a section once, must have been 4 years ago, where a student raised her hand and said, "Professor, my mother got hit by one of these schemes. The car shut off on the way to chemotherapy." And I want you to understand that I had been lecturing about consumer protection for 15 years at that point, and I had no good answer. No good answer in the formal legal sense, and no good answer in the engineering sense either, because the legal system as currently configured has no port to plug her into. There is no $9 pathway. There is no 1,800 share aggregation. There is nothing. And it bothered me. It still bothers me. And I think part of why I take redress seriously, even though I have a lot of skepticism about whether the regulatory exposure can be managed, which we will get to, is that it is the first attempt I have seen at building the port, at constructing the layer that does not currently exist between the 1,800 reviews and the courthouse. Let me sharpen the second order point. The hole in the protective architecture is not an accident. The hole is structural. The contingency fee filter exists because lawyers are economic actors. Lawyers will not work for free. Therefore, harms below a certain threshold are uneconomic to pursue. Therefore, the floor exists. Therefore, bad actors who operate below the floor are, in effect, subsidized by the architecture of the legal system itself. The system is not failing them. The system is, in its current configuration, structurally aligned with them. And that alignment has produced, over the last 40 years, roughly speaking, an entire shadow economy of operators who have learned exactly where the floor is and priced their bad behavior to stay just underneath it. $240 tow tickets, $340 storage unit penalties, $500 lease termination fees. The numbers are not random. They are engineered. Stay with me. The point is that what redress is actually attacking is not bad behavior. What redress is attacking is the architectural condition that makes the bad behavior pencil out. That is a much more interesting target. Now we have to figure out how it got there. I want to take you back, way back. Not because I love legal history, although I do, but because if you do not understand the constraint that has been there for 400 years, you cannot understand why what redress is doing looks both inevitable and illegal at the same time. In medieval England, there was a doctrine called champerty, spelled the way it sounds, more or less. Champerty was the practice of a third party funding someone else's lawsuit in exchange for a share of the recovery. Closely related were the doctrines of maintenance, which was just funding the lawsuit, and barratry, which was stirring up litigation that would not otherwise exist. All three were crimes. Why? Because in medieval and early modern English law, the lawsuit was treated as a sacred dispute between two parties before the king's courts. The introduction of a third party with a financial stake was considered a corrupting influence. It would, in the language of the time, encourage litigation. It would turn justice into a market. And the courts, the church, and the crown all agreed this was bad. These doctrines came over to America with the common law. By the late 19th century, every American state had some version of champerty prohibition on the books. Some criminal, some civil, some merely contractual. The basic rule was the same. You cannot buy a lawsuit. You cannot fund somebody else's lawsuit in exchange for a piece of the recovery. The lawsuit must belong to the person who was harmed. Now, here is the interesting part. Right around the same time, late 19th century, the contingency fee system was being developed in the American Plaintiffs' Bar. Lawyers representing injured workers, railroad accident victims, mostly working class plaintiffs. And the contingency fee system was, on its face, a violation of the champerty prohibition. The lawyer had a financial stake in the lawsuit. The lawyer was funding the lawsuit. The lawyer was getting a share of the recovery. By the strict doctrine, this should have been illegal. What happened? The courts carved out a specific exception. Lawyers, and only lawyers, were allowed to take contingent fees because lawyers were officers of the court. They had ethical obligations. They were professionals. The exception was lawyer-specific. Nobody else could buy a piece of a lawsuit, only the licensed attorney. And that exception is, broadly speaking, still the law in most states today. So for about 100 years, from roughly 1880 to 1980, the contingency fee was the only legal way to finance American litigation. The plaintiff's bar grew up around it. The mass torts of the 20th century, asbestos, tobacco, Dalkin Shield, Vioxx, opioids, were all financed on the contingency fee model. Big law firms taking cases on contingency, fronting the litigation expenses out of their own pockets, accepting the risk in exchange for 30 to 40% of the recovery. It worked. It worked very well for the lawyers. It worked, in many cases, very well for the plaintiffs, too. But it did not work for small claims because, as we said, the contingency fee filter cuts off at roughly $4,000 in expected recovery. Anything below that, the lawyer cannot afford to take. So below the floor, harms went unaddressed. Now, the third-party litigation funding industry. This is the part of the story most people, including most lawyers, do not know. Sometime in the late 1990s, in Australia of all places, a few entrepreneurs noticed that the champerty doctrines had been quietly relaxed in some Commonwealth jurisdictions. They started a company called IMF Bentham, later renamed Omni Bridgeway, that funded commercial litigation, big commercial lawsuits, one company suing another company over a contract breach worth tens of millions of dollars. the funder would pay the legal fees. If the plaintiff won, the funder got a piece, often 30 to 40%. If the plaintiff lost, the funder ate the loss. It was, in plain language, the financialization of legal claims. By 2009, this had crossed the Atlantic to the United Kingdom, and shortly thereafter, with great delicacy, to the United States. The American flagship is Burford Capital, founded in 2009, now publicly traded in London, also on the New York Stock Exchange under the ticker BUR. Last I checked, the global industry is somewhere between $13 and $17 billion in committed capital, depending on whose numbers you believe. There are at least 50 active funders. Some are publicly traded, many are private. The largest single deal, I am told, was somewhere north of $75 million for a single case. Read that again. $75 million to fund a single lawsuit. And here is the part that bears on redress. The third-party funding industry, as currently configured, only finances commercial litigation. Big stuff. Patent suits, international arbitrations, antitrust cases. The economics work because the recoveries are enormous and the per-case oversight cost is high but justifiable. The industry has not, by and large, touched consumer litigation. Why? 2 reasons. 1, the per-case dollar value of consumer claims is too low to justify the underwriting cost. 2, the regulatory exposure is much higher because most state champerty doctrines were specifically written with consumer litigation in mind. The very thing that the medieval doctrine was designed to prevent, the stirring up of small claims into mass litigation, is exactly what consumer-facing funding would do. The funders have stayed away. A short story. I had dinner, this must have been 2018, with somebody who runs a litigation finance fund, not Burford, but in that orbit. He told me, and I am paraphrasing because the conversation was off the record, that the holy grail of the industry was consumer litigation funding. That if anybody could crack the regulatory shell on consumer financing, the addressable market was an order of magnitude larger than commercial litigation, possibly 2 orders of magnitude, and that the reason nobody had cracked it was because the unit economics required aggregation that nobody knew how to build. You could not underwrite 10 million consumer claims one at a time. You needed a front end, a consumer-facing layer. Something that would do the data collection, the documentation, the eligibility screening, the marketing, the per-claim cost amortization. The funder said, and I remember this clearly, somebody's going to build that layer, and when they do, the entire industry shifts. That was 2018. The redress deck, when I saw it, looked to me like the first plausible attempt at building exactly that layer. Whether it gets through the regulatory thicket, I genuinely do not know. But the gap it is trying to fill has been visible to the people who think about this for a decade. Now, why does any of this matter for what comes next? Because if you understand that we are sitting at the convergence of 3 trends, the 400-year decline of champerty enforcement, the 40-year evolution of the contingency fee filter, and the 15-year rise of third-party litigation funding, then you can see that redress is not an outlier. Redress is the inevitable consumer-facing endpoint of an industry that has been building toward it for a generation. And the people who run that industry, the senior partners at the firms, the principals at the funds, they have been waiting for exactly this, quietly, without writing about it, because the people who profit from a structural shift are rarely the ones who announce it in advance. They prefer to be already positioned when it arrives. All right, let us actually get into how redress is supposed to work at the surface before we get into the parts that I think are genuinely strange. A high school student should be able to follow this part. I am going to walk through it slowly because the surface layer is also the part that makes the whole thing operate. A consumer signs up. The fee is in the neighborhood of $9 a month, although I have seen the deck quote 5, so let us say somewhere between 5 and 9. The consumer is buying 2 things with that fee, although the marketing only emphasizes 1. First, the consumer is buying a documented complaint file. They upload photos, they upload receipts, they upload chronological account narratives, they flag the offending business, the platform timestamps everything, captures metadata, and stores it in a structured database. The complaint goes into a file. A file is, at the simplest level, a folder of evidence about a single bad actor. Second, and this is the part the marketing does not emphasize, the consumer is buying a share, a unit, a position, in any future recovery that the file generates. If the file is later sold to a law firm, or if it becomes the evidentiary basis of a lawsuit, the participants in that file are entitled to a share of the recovery. The mechanics of the share are, I think, still being worked out, but the principle is the part that matters. $9 a month is not a service fee. It is a position size. Now, the platform aggregates. Across thousands of subscribers, multiple complaints against the same business get clustered into a single file. The file grows. When the file reaches a threshold, a number of participants, a quality of documentation, a coherent pattern of misconduct, a damages estimate, the platform takes the file to market. The market is the plaintiff's bar. Specifically, law firms that handle mass consumer litigation, class actions, false advertising claims, unfair and deceptive practices claims, Lehman law claims, depending on the jurisdiction. The law firm reviews the file. The law firm, in effect, is buying due diligence that they would otherwise have to perform themselves at considerable cost. The law firm assesses the case, makes an underwriting decision, and either takes the case on contingency or passes. If they take it, the consumers who participated in the file are signed on as plaintiffs. The case proceeds through whatever channel is appropriate: small claims, mass tort, class action where feasible, attorney's general referral where not. If there is a recovery, the participants get paid. The platform gets a piece. The law firm gets the standard contingency cut. Here is where the model gets clever. There is a parallel revenue stream that runs entirely separate from the litigation pathway. As complaints come in, the platform also publishes a curated version of the file to a public-facing site. Think of it as a structured, time-stamped, evidence-backed accusation against the business, not a Yelp review, a documented dossier with search engine optimization, which means when somebody Googles the business, the dossier appears in the search results, possibly near the top. The business has a problem. The dossier is not a review. It is not subject to platform moderation in the same way Yelp or Google would moderate. It is a structured publication. And so the business, if they want the dossier off the first page of search results, has to negotiate with the platform. The platform offers a removal mechanism, pay a fee. The dossier comes down, possibly with conditions, possibly with documentation that the underlying complaints have been resolved. The business is, in plain language, paying to remove a public record of consumer harm. Now, I want to be careful here, because this is the part where the model starts to look uncomfortably close to extortion, and I am going to come back to that. But the model's defense, as I understand it, is that the platform reserves the right to publish based on the same First Amendment principles that allow any consumer reporting service to publish negative reviews. The business has no right to suppress the truth. The platform has no obligation to remove documented complaints. The pay-to-remove mechanism is, in this telling, a service the platform offers as a courtesy, not a ransom. Whether that distinction holds up under legal scrutiny is, let us say, contested. Let me give you a worked example. Imagine the buy here, pay here lot we talked about earlier. 1,800 reviews across various platforms. Now imagine 300 of those reviewers sign up for redress. They pay their $9 a month. They upload photos of the GPS kill switch hardware, copies of the financing contracts, screenshots of the threatening text messages, dated logs of the times the car shut off. The platform aggregates. The file becomes, frankly, the single best organized body of evidence against this business that has ever existed. Better than what any individual law firm could have assembled, better than what the Attorney General's office could have built without burning 6 months of staff time. The platform takes the file to a law firm in Phoenix that specializes in subprime auto lending litigation. The law firm reviews. The damages estimate is, let us say, somewhere between $4 million and $12 million, depending on how aggressively they push the unfair and deceptive practices claims. The firm takes the case. Each participant is signed on as a plaintiff. The case proceeds. Settlement comes a year later, somewhere in the middle of the damages range. Each participant gets, after fees, somewhere between $2,000 and $7,000. Compared to the $9 a month they paid, that is, well, you can do the math. It is a return that retail investors do not see on any other product. Now stay with me, because the second piece is what makes the model actually run. The platform's revenue is not primarily the cut of the settlement. The settlement cut is sporadic, lumpy, hard to model. The platform's revenue is, in steady state, the subscription fees from millions of subscribers and the dossier removal fees from thousands of businesses. The litigation pathway is the marketing. The litigation outcomes generate press. The press generates subscribers. The subscribers generate dossiers. The dossiers generate removal fees. The removal fees are the recurring revenue. The lawsuits are the customer acquisition mechanism. A cross-domain analogy that I think actually works. Think about how a credit bureau operates. Equifax does not make most of its money by giving credit reports to individuals. Equifax makes its money by selling data to businesses that need to assess creditworthiness. The individuals are the input. The businesses are the customers. Redress, if you squint, is a credit bureau for corporate misbehavior. The consumers supply the data. The data forms a reputation file. The reputation file is the asset. The business that wants the file suppressed is the customer, which means the platform's deepest interest is in maximizing the volume and severity of documented misconduct, because that is what gives the file its value. And yes, that is a strange incentive structure to think hard about. We will get to that. I want to flag one thing before we move on, because I'm going to come back to it later and it matters. Earlier I said that redress is a broker between consumers and law firms. I want to partially take that back, or at least complicate it, because what redress is actually brokering is not consumers and law firms. What redress is brokering is evidence and capital. The evidence comes from the consumers, the capital comes from the law firms, and behind the law firms, from the litigation funders. Redress sits in the middle and takes the spread. That is a much sharper way to see what is going on, and it tells you where to look for the parts of this model that we have not yet talked about. Okay, the surface layer is frankly the boring part. The hidden wiring is where this gets interesting, and where I want to spend the rest of our time. Because what is actually being constructed here, if I am reading the structure correctly, is not a startup. It is a new kind of financial instrument that has not been built before, dressed up in startup clothes for regulatory cover. And the people who already operate in adjacent markets are going to see it very quickly, even if the rest of us do not. Layer 1 of the hidden wiring is the legal exposure. Champerty is the load-bearing wall. In about half the states, the doctrines have been substantially relaxed or repealed. Texas, for instance, repealed champerty as a criminal offense in the early 1960s. New York has narrowed its champerty doctrine through a series of cases, including the famous Bluebird case in 2016. Other states, including Mississippi and Pennsylvania, have left the doctrines on the books, but rarely enforce them. The picture is messy, but about half the states still have enforceable champerty restrictions. And redress, as I understand the model, is brokering legal claims for profit, which is the textbook definition of champerty in the strict states. The legal defense is going to be that redress is not buying claims, it is brokering information. The platform never owns the claim. The claim stays with the consumer. The platform takes a service fee. Whether that distinction holds up before a hostile state Supreme Court in, say, Mississippi, is something I would not bet a salary on. A digression that matters. There is a state, I'm going to leave it unnamed because the litigation is ongoing, where a similar funding model was recently struck down on champerty grounds. The court held that even though the funder did not technically own the claim, the funder's contractual rights over the litigation, including consent rights on settlement, amounted to ownership in substance. The case is on appeal. If it goes the wrong way, the entire third-party funding industry has to rewrite its contracts in that state. Redress is going to face a version of that question in every state, repeatedly, for the next decade. And the legal cost of fighting those battles is, by itself, a load on the model that has to be priced in. The deck I saw did not price it, which is one of my concerns. Layer 2 of the hidden wiring is something I want to call the embedded option problem, and this is where the asset class language earns its keep. When a consumer pays $9 a month into the platform, what they are really purchasing is a portfolio of out-of-the-money options on legal recoveries against an unknown set of bad actors. Each documented complaint is, in effect, a call option struck at the threshold of legal viability, with an unknown but non-zero probability of expiring in the money. The consumer does not know which of their complaints will hit. The platform does not know either. But the aggregate portfolio, across all subscribers, has a calculable expected value if you have enough data on litigation outcomes and underlying bad behavior rates, which means, in principle, the platform's own equity can be valued not on revenue multiples, but on the expected value of the option portfolio it is sitting on. This is the language a litigation funder thinks in. It is also the language a structured products desk at an investment bank thinks in. And once you can value the option portfolio, you can do something interesting. You can borrow against it, you can securitize it, you can sell a tranche of expected recoveries to a hedge fund and take the cash up front, the legal claim equivalent of a mortgage-backed security. Now, before anyone gets too excited, I want to say very clearly, the regulatory exposure on that kind of securitization is, at the moment, a vertical wall. Nobody's doing it because nobody has figured out how to do it without triggering securities regulation, champerty doctrines, and unauthorized practice of law statutes all at the same time. But the conceptual structure is there, and someone is going to figure it out. And when they do, the addressable capital pool for consumer litigation goes from the current several billion to something on the order of magnitude of asset-backed securities issuance, which is hundreds of billions. Stay with me. The reason this matters is that the financialization of the bottom of the legal market would do to small businesses what the financialization of subprime mortgages did to small lenders in 2007. It would dramatically expand the scale at which capital could enter the market, dramatically lower the cost of pursuing bad actors, and dramatically reshape the behavior of every operator who currently sits below the $4,000 contingency floor. The buy here, pay here lot in Tucson, the towing operator in Phoenix, the mobile home park in Florida, they are not going to be able to operate under the same assumptions about consequence-free harm that they currently operate under. Some of them will adapt. Some will go out of business. Some will be sued into oblivion. The economics of operating in that zone change, possibly within a 5 to 10 year horizon, in ways that the operators do not currently price. Let me give you a second order effect I find genuinely strange. If redress works at scale, insurance markets respond. Small business liability insurance starts to underwrite for redress exposure. Premiums adjust. Some businesses become uninsurable, which means the cost of operating a buy here, pay here lot goes up, not because of lawsuits, but because of insurance. Marginal operators exit. The supply of subprime auto financing declines. The people who are being preyed on by those operators no longer have access to a car, which is its own conversation, a complicated one. The same mechanism that protects them from predation may also remove their access to the only credit market willing to serve them. The welfare math on that is not as obvious as you would think. I am, frankly, not sure I have a clear answer. A cross-domain analogy I want to plant, because I think it tells you where this goes in 20 years. There is a parallel in the history of class action securities litigation in the 1990s. Before the Private Securities Litigation Reform Act of 1995, the plaintiff's bar had a kind of plug-and-play machine for filing securities class actions against any company whose stock dropped more than a certain percentage. The mere existence of that machine changed corporate disclosure behavior, board composition, audit committee design, and insurance pricing for every public company in the United States. The machine did not have to actually file a suit. It just had to exist as a credible threat, and every public company restructured its behavior in response. If redress, or something like it, builds the consumer-facing version of that machine, the same thing happens at the small business level. Every operator below the $4,000 contingency floor restructures behavior, not because they get sued, because they might. Because the cost of being sued has gone from effectively zero to plausibly six figures, and the probability of being sued has gone from effectively zero to plausibly 30 to 50%, depending on the conduct. That shift in expected value is enough to reorganize an entire shadow economy. And the shadow economy is, last I checked, somewhere on the order of $200 billion of annual consumer-facing transactions in the United States. The number is a guess. Nobody actually has it. But that is the rough territory. Last beat. There is an argument that what redress is doing is morally ambiguous in a way the marketing does not acknowledge. The model, structurally, is incentivized to maximize documented misconduct. The platform makes money when there is more bad behavior to document. The platform has an interest, at the margin, in finding misconduct, amplifying misconduct, possibly even in encouraging the kind of disputes that turn into documented complaints. That is a strange place to put a business. It is the same structural critique that has been made of plaintiffs' lawyers for 100 years. The bar's defense has always been that the system is self-correcting because frivolous claims lose in court, which is true, more or less, in the long run. But in the short run, the mere existence of the platform changes behavior in both directions. It deters bad actors. It also creates new categories of accusation. The architecture that protects the chemotherapy patient also empowers the unreasonable customer with a grudge. And reasonable people are going to disagree about whether the net is positive. I think the net is positive. I want to say that on the record. The architecture of consequence-free small harm has been a load-bearing structure of the worst parts of the American consumer economy for 40 years, and dismantling it is, on balance, a worthy project. I also want to acknowledge that the people working on it have not, as far as I can tell, fully internalized the strangeness of the incentive structure they are building inside of. There is going to be a moment, 3 or 4 years from now, when a redress-style platform faces a public scandal involving a coordinated harassment campaign against a small business that turned out to be innocent. The platform is going to have to answer for it. The answer better be better than the one Yelp gave when Yelp faced its version of that moment a decade ago. That is the moral conversation nobody has had yet. The structural conversation has not happened either. Topology, moats, capital engineering, adversarial game theory, the political endgame, that is what we get into next. There are, by my count, about 30 different ways this business gets shut down. I want to walk you through the map, not to scare you, to show you something about how regulatory exposure actually works inside a real startup, which is, frankly, badly understood by most people who work in startups. The conventional wisdom is that you either are or are not legal. That is wrong. Regulatory exposure is a topology. You are simultaneously legal in some states, illegal in others, in a gray zone in a third group, and operating at the edge of an emerging interpretation in a fourth. Your job, as the founder, is not to be legal. Your job is to know exactly where you are on the map and be able to move when the map shifts. A cross-domain image that I think actually helps. Think about a mountaineer planning a route up a complicated face. There are exposed pitches, sheltered ledges, rockfall zones, sections that are easy when dry and lethal when wet. The mountaineer's job is not to find a route that is risk-free. There is no such route. The job is to know the conditions on every pitch, time the moves correctly, and have a retreat plan when a section turns. Regulatory topology is the same. The founder picks the line moves. Let me list, in rough order of danger, the legal vectors redress faces. Champerty and maintenance. We already covered this. About half the states have enforceable doctrines. The other half do not. The patchwork means redress will be operating with one set of rules in Texas, another in Mississippi, another in Delaware, and a fourth in New York. The cost of state-by-state legal opinions is, by itself, several $1 million over the first 3 years. Unauthorized practice of law, also called UPL. This is the one I would worry about most if I were the founder. Every state has a statute that prohibits anyone who is not a licensed attorney from giving legal advice or representing clients. The bar associations enforce these statutes with a kind of guild-like zeal that, frankly, has nothing to do with public protection and everything to do with protecting the monopoly. Redress's defense will be that the platform does not give legal advice. The platform aggregates complaints and brokers introductions to licensed lawyers. The platform is a marketplace, not a law firm. That defense has worked for LegalZoom, more or less. It has not worked for several other companies. It is going to be litigated for a decade. Section 230 of the Federal Communications Decency Act. This is the statute that immunizes online platforms from liability for user-generated content. Yelp has this protection for the reviews users post. Redress will claim the same protection for the user-submitted complaints in its dossiers. Here is what most people miss. Section 230 immunity is not absolute. It does not protect platform-generated content. And the moment redress curates, structures, or editorially shapes a dossier, which is exactly what the model requires it to do to make the dossier valuable to law firms, the platform's editorial role starts to look like authorship, and the Section 230 shield starts to crack. The Ninth Circuit case Roommates.com in 2008 is the precedent everyone should be reading. The court held that when a platform's interface materially contributes to the creation of unlawful content, Section 230 does not apply. Redress is going to live in the shadow of that case. Defamation. If you publish a dossier accusing a business of unfair trade practices and the accusation is false, that is defamation. Some categories of false statements are defamation per se, meaning damages are presumed without proof. Statements accusing someone of professional misconduct fall into that category in most states, which means the defamation exposure on the dossier publication arm of the business is enormous. The defense will be truth, fair report, and the structured opinion privilege. The defense will work for cases where the complaints are documented and accurate. The defense will fail for cases where, say, one complainant was a competitor running an AstroTurf attack. And it will only take a handful of those failed cases to create case law that becomes the platform's permanent ceiling on growth. Fair credit reporting analogs. The Federal Fair Credit Reporting Act regulates entities that compile and sell information used to assess the creditworthiness or character of individuals. Redress, in its dossier marketing arm, is doing something that looks uncomfortably close to that. The defense is that redress collects information about businesses, not individuals, and the act does not apply. Several states have analogous statutes that cover business information as well, and the line between the two is, in practice, blurry. The pay-to-remove mechanic. This is the one that, if I had to bet on a single legal vector taking the company down, I would bet on. State extortion statutes and the Federal Hobbs Act prohibit obtaining property through wrongful use of fear of economic harm. Charging a business to remove a public dossier that accuses them of misconduct is structurally adjacent to extortion. The defense will be that the dossier is truthful, the removal is voluntary, and the fee is for editorial services rendered. In some jurisdictions, that defense will not work, and in the jurisdictions where it does not, the criminal exposure is, well, criminal exposure. A digression about something I think most people get wrong about regulatory risk in startups. The conventional wisdom is that regulators are looking for fights and that any legal gray area will be pounced on. That is not how it actually works. Regulators are, with rare exceptions, understaffed, underfunded, and politically constrained. They pick fights they can win. They pick fights that play well in the press. They pick fights against companies that lack the resources to litigate back. A startup with $30 million of venture funding and aggressive outside counsel is, in many ways, a much less attractive target than a strip mall debt collector, which means the actual regulatory risk to redress is not from the federal agencies. It is from individual state attorneys general looking to make a political career, and from the bar associations protecting their guild. Those are the people who file the cases that matter, and those are also the people who tend not to get covered in the trade press, which means most founders do not see them coming. A short story. I had coffee years ago with a former state attorney general from a mid-sized state. Off the record, he told me that when his office decided whether to investigate a consumer-facing tech company, the deciding factor was almost never the merits of the complaint. It was the politics. Was the company popular? Was the company politically connected? Did pursuing the company embarrass somebody on the other side of the aisle? The merits were table stakes. The politics were the whole game. He told me, and I remember this clearly, that any startup operating in a regulated space that did not have a dedicated political affairs function within 3 years of launch was, in his words, basically asking to be made an example of. I have thought about that conversation, must be, a dozen times since. One last vector, and this is the most strategically interesting, mandatory arbitration clauses. Almost every consumer contract in the United States, since the Supreme Court's 2011 decision in AT&T against Concepcion, contains a mandatory arbitration clause with a class action waiver. The clauses were designed to kill class actions. They worked, but they worked too well. Because they killed the ability to bring claims as a class, the plaintiffs' bar developed a counter-strategy known as mass arbitration. Tens of thousands of individual arbitration claims filed simultaneously, each one requiring the defendant to pay arbitration fees up front. The fees alone, before any merits decision, can run into the hundreds of millions of dollars. Postmates faced this, Uber faced this, DoorDash faced this. The companies that had relied on arbitration clauses as a shield discovered that the shield could be used as a sword. And redress, structurally, is the perfect engine for mass arbitration. It already aggregates the complaints. It already has the named claimants. It already has the documentation. The arbitration clauses that were supposed to kill class actions become, in the redress model, the unlock for the next wave of mass legal action, which is the kind of inversion you only see when somebody is paying attention to the second-order effects. That is the topology. Now let us talk about why this is defensible. I want to put on the litigation finance hat for a moment because there is something happening here that, if you have not worked at a structured products desk, you might miss. The redress capital stack is not a startup capital stack. It is a financial engineering problem dressed up in startup clothes, and once you see the financial engineering, you cannot unsee it. Layer 1 is subscription revenue. $9 a month, predictable, recurring, low margin per subscriber, but extremely high quality of earnings for valuation purposes. Software as a service multiples apply. This is the layer the typical venture investor underwrites because it is the layer they know how to model. If redress hits, let us say, 1 million paying subscribers within 4 years, that is roughly $100 million of annual recurring revenue. At 10 times revenue, which is the going rate for vertical software with high retention, that is a $1 billion valuation just on the subscription layer, without any of the other revenue streams, which is itself a venture scale outcome. Layer 2 is removal fees, businesses paying to suppress dossiers. This is, frankly, the most beautiful revenue stream I have seen in a long time, from a unit economics perspective. The cost of producing a dossier is, marginally, almost zero, because the consumers have done the work for free as part of their subscription. The cost of taking the dossier down is also almost zero. The price the business will pay to make the dossier disappear is, by contrast, the lifetime value of the business's reputational damage. That can run from a few $1,000s for a single location operation to a few million for a regional chain. The gross margin on each removal fee is, structurally, 95% plus. That is software margin without the software. Stay with me. Layer 2 creates a problem for valuation. Removal fees are, by their nature, episodic, lumpy, hard to forecast. The revenue is real, but the timing is unpredictable, which means the multiple the market will pay for Layer 2 revenue is lower than the multiple for Layer 1, even though the unit economics are dramatically better. This is the kind of inefficiency financial engineering exists to fix. You convert lumpy, episodic revenue into smooth, predictable revenue by structuring it as a subscription, which redress will do. Subscription-based reputation management. Businesses pay a monthly fee to have first-look access to dossiers about themselves and the ability to dispute or remove them as part of the package. Now, Layer 2 has become Layer 1. The lumpy turns smooth, the multiple expands, the valuation triples. Layer 3 is the litigation share, the piece of recoveries from cases generated off the platform's files. This is, in absolute terms, the largest revenue layer, but the lumpiest. A successful mass tort can generate $100 million or more in recoveries. Redress is cut, depending on the structure, might be 5 to 15%. So a single big case could be a $15 million revenue event, then nothing for 2 years, then another big case. The pattern is the same as a venture capital firm's distribution, lumpy, but with massive upside on the hits. Now, this is where the engineering gets serious. The lumpy litigation share on its own is not financeable. No bank will lend against it. No public market will pay a reasonable multiple. The cash flow looks too much like a hedge fund or a venture firm to qualify as a normal corporate income stream, which means the litigation share, in its raw form, sits trapped on the balance sheet as a kind of phantom asset whose value cannot be unlocked. Unless you tranche it. Here is the financial engineering move that, I promise you, somebody on a structured products desk is already modeling. You take the expected litigation recoveries across a portfolio of active files, say 1,000 active files at varying stages of maturity. You tranche the expected cash flows, a senior tranche, paid first, with high probability of full recovery but low absolute return. A mezzanine tranche, paid second, with moderate probability and moderate return. An equity tranche, paid last, with low probability but lottery-like upside. The senior tranche can be sold to insurance companies and pension funds looking for low correlation yield. The mezzanine tranche can be sold to hedge funds. The equity tranche can be retained or sold to high net worth individuals looking for asymmetric exposure. This is structurally exactly what asset-backed securitization did for mortgages in the 1980s. And the moment redress, or somebody like it, builds this structure, the capital available to fund consumer litigation goes from the current several billion of committed litigation capital to something on the order of asset-backed securities issuance, which is hundreds of billions globally. I want to be careful here because this is the part where I get accused of being either too excited or too pessimistic. The mortgage parallel is real, but it is also dangerous. The same financial engineering that unlocks capital for legitimate consumer claims can be used to unlock capital for, frankly, garbage claims. The same securitization machinery that funded affordable housing also funded the subprime crisis. There is no clean answer to which side this comes out on. The honest answer is that it depends on the underwriting discipline of the people doing the tranching and the regulatory environment they operate in. The regulatory environment for litigation finance right now is, let us say, immature, which means the first decade of tranched litigation securities is going to be messy, possibly very messy. A worked example for the tranching because I think it makes the architecture concrete. Imagine a portfolio of 1,000 active complaint files distributed across 500 named defendants with an aggregate expected recovery, after underwriting, of about $300 million over 4 years. The recoveries are probabilistic. Some files will yield nothing, some will yield small settlements, a handful will yield large recoveries. The senior tranche, sized at 100 million, gets paid first out of whatever the portfolio recovers. Probability of full recovery, maybe 95%. Yield, maybe 7% annual. That is a credit-like instrument. Insurance companies buy that. The mezzanine tranche, sized at 100 million, gets paid next. Probability of full recovery, maybe 60%. Yield, maybe 15% annual. Hedge funds and family offices buy that. The equity tranche, sized at the residual 100 million of expected upside, gets whatever's left after the senior and mezz are paid. Probability of meaningful recovery, maybe 30%. Expected return, conditional on hitting, maybe 50% annual. Sold to high net worth individuals or kept by the platform. The total capital raised against this single portfolio is $200 million in pre-recovery cash, which is more than most of these law firms could raise on their own in a decade. Layer 4, the wild card, mass arbitration coordination. We touched on this. The economics are, frankly, ridiculous. A platform that aggregates 10,000 arbitration claims against a single defendant and serves them all simultaneously forces the defendant to pay, depending on the arbitration forum, somewhere between $1,000 and several $1,000s per claim in administrative fees alone before any merits ruling. The math. 10,000 claims times, let us say, $3,000 per claim equals $30 million of arbitration fees the defendant has to pay just to defend. The settlement value before merits can be 10 times that, which means a platform with 5 mass arbitration campaigns running simultaneously is sitting on, conservatively, $100 to $200 million of pre-merit settlement leverage per quarter, which is, in financial terms, the kind of revenue stream that justifies any valuation you want to put on the business. Anecdote. A friend who runs a small litigation finance fund told me, must have been a year ago, that the firm had developed a proprietary model for valuing mass arbitration portfolios. He would not share the specifics. He said the model gave numbers that, when he first ran them, he thought were errors. He recalibrated, reran, same numbers. The implied returns on a well-constructed mass arbitration portfolio were, in his words, the highest risk-adjusted returns he had ever seen in any asset class. Higher than venture, higher than private equity, higher than distressed debt. He was, when I last talked to him, trying to raise a dedicated fund for it. I do not know if the fund happened. The point of going through the capital stack in this detail is that the surface business, a consumer protection startup, is the front end for what is, behind the curtain, a sophisticated financial engineering opportunity. And the people who can do both pieces, the consumer-facing brand work and the structured products, engineering on the back end, are, frankly, a small number of people, which is itself a moat I should have mentioned in the last section. Now, the bad news, the adversarial dynamics. I have spent the last 3 sections being, you might say, an enthusiastic structural analyst. I want to spend a section being a structural pessimist, because the adversarial dynamics are real, and most founders dramatically underestimate them. When you build a business that profits from documenting corporate misconduct, every business you document becomes, in some sense, your enemy. Most of them will ignore you, some will negotiate, a handful will fight. And in the fight, you discover something about the legal and political ecosystem that is not on the regulatory map. The defendants have a playbook. It is well developed, it has been refined over 40 years of consumer protection litigation, and redress is going to encounter every move in it. Move 1, the defamation countersuit. Sue the platform for publishing false statements. The suit does not have to win. It only has to cost the platform money to defend. Tens of thousands of dollars per case in legal fees. Multiply by hundreds of cases, which is what a successful platform will generate, and you have a substantial cost of doing business. The defendants do not need to win any of these suits. They need to make the cost of being sued by redress higher than the value of suppression. The defense is, partially, anti-schlep statutes that protect platforms from frivolous defamation suits in some states. Not all states have anti-schlep statutes. And in the states that do not, the defamation playbook works. Move 2, the digital takedown abuse. File false copyright takedown notices against the dossiers. The notice forces the dossier offline pending review. The review takes days or weeks. During that window, the dossier is inaccessible. The defendant has, in effect, won by procedure. The defense is to challenge the false notices, which takes time and money. The cost asymmetry favors the abuser. Move 3, the AstroTurf attack. coordinate fake complaints against a competitor. The defendant pays operatives to file fabricated complaints. The platform's dossier against the competitor grows. The competitor either pays for removal or loses business. The platform, structurally, has an incentive to publish without verifying, which means the platform becomes, accidentally, a weapon for competitive sabotage. The defense is rigorous identity verification and complaint validation, which is expensive, which raises the cost structure of the business in a way that compresses margin and slows growth. Move 4, and this is the one that worries me most. Coordination liability. When a platform organizes 10,000 consumers to take action against a defendant, the platform crosses the line from publishing information to coordinating conduct. Coordinating conduct, in some legal frameworks, can be conspiracy, and conspiracy carries criminal exposure. The defense is that the platform's role is administrative, not directive. The consumers make their own decisions. The platform just provides the infrastructure. That defense will work in most cases. It might not work in all, and the cases where it fails create criminal precedent that is, for the platform, existential. Move 5, regulatory capture by the defendants. The National Federation of Independent Business, the Chamber of Commerce, the various trade associations representing small businesses, they have enormous lobbying capacity at the state level. The moment redress starts taking down enough buy here, pay here lots and predatory tow operators to threaten the substrate of those industries, the trade associations will go to their state legislators and ask for protective legislation. The protective legislation will, in various guises, restrict third-party complaint platforms, limit mass arbitration, expand champerty restrictions, or impose registration requirements that are functionally prohibitive. The defense is, partially, federal preemption arguments and First Amendment arguments. The defense will work in some states and lose in others, a self-correction. Earlier I said the moats are real. I want to partially take that back. The moats are real against other startups. The moats are weaker against incumbents with patience. And the moats are basically non-existent against state legislatures that decide they do not like the business, which is a structural vulnerability that no amount of product engineering can fix. The only defense against a hostile legislature is political, which means redress has to play politics, which means it needs allies, which means it needs to be careful about which fights it picks. Move 6, the Streisand effect, used as a weapon. Counterintuitively, the defendant's best move in some cases is to fight loudly. Sue the platform. Sue the named complainants. Bring counterclaims. The litigation gets press coverage. The press coverage makes everybody else hesitate to file complaints. The platform's growth slows. Even if the defendant loses the case in court, they have won the deterrence game. The defense is, partially, that the platform's lawyers absorb the litigation for the complainants pro bono, which is expensive, which compresses margin. A specific case study that I think encapsulates all of this: Yelp. Around 2014, Yelp faced a series of lawsuits from small businesses claiming that Yelp was manipulating reviews to extort advertising payments. Yelp denied. The case got to the Ninth Circuit. The court held, more or less, that Yelp was entitled to make its own editorial decisions about which reviews to display. The case was a legal victory for Yelp. The press coverage was devastating. The narrative that Yelp extorted small businesses became, fairly or not, embedded in the public consciousness. The brand damage from that narrative is still visible. Redress is going to face the same narrative, possibly worse. The pay to remove mechanic, even if entirely legal, looks like extortion to anybody who is not paying close attention. And most people are not paying close attention, which means the brand risk for redress is enormous, regardless of whether the underlying conduct is defensible. A short story I think about a lot. A former student of mine who is now in-house counsel at a regional retail chain called me, must have been 18 months ago, in a state of mild panic. He had received a letter from a platform similar to redress in concept, though smaller. The letter detailed 47 consumer complaints against his employer over the previous year. Each complaint was time-stamped, photographed, and documented. He said, and I remember this, that the letter was the single most professional piece of plaintiff side correspondence he had ever seen, including from major plaintiff firms. He spent the next 4 months negotiating a settlement. The settlement was, in his words, the most expensive line item his department processed that year, including the actual litigation budget. And the platform that wrote the letter was, I am told, a 3-person operation working out of a co-working space in Texas. 3 people, with the right data architecture, leveraging mass arbitration, brought a regional retail chain to the negotiating table on terms the chain had no good answer to. That is what the future looks like when this architecture matures. A game theory observation that I think is the deepest insight in this section. In iterated games, the equilibrium strategy is what game theorists call tit for tat. You cooperate as long as the other party cooperates. You retaliate when they defect. The defendants. Redress is going to be encountering have already chosen their strategy. They are defectors by definition. The platform's challenge is to credibly signal that it will retaliate at scale when defendants attack, while also being able to cooperate when defendants negotiate in good faith. The signaling problem is, in practice, extremely difficult, because the platform's individual employees making decisions about whether to fight or settle each case have asymmetric information and asymmetric incentives, which means the platform's strategy ends up being inconsistent. Inconsistent strategy in iterated games is the worst possible outcome. It invites maximum defection from the other side because the cost of defection is not predictable. The platform either has to commit to a credible escalation strategy across all cases, or it has to commit to a credible cooperation strategy across all cases. Mixing them is what gets you killed. The point: adversarial dynamics are not a footnote. Adversarial dynamics are the dominant operational reality of running a business like this. Every product decision, every pricing decision, every customer service decision has to be filtered through the question of how the worst-case defendant will exploit it, which is a kind of paranoia that founders in normal startups do not have to develop, which is, again, the schlep moat. Most founders do not want to run this kind of company. The ones who do and who can do it well are the ones who get to keep the entire market. Now, the last section. What happens if it works? I want to close by talking about what this looks like in 10 years if it works. And I want to do it honestly, not as a marketing pitch, because I think the picture is genuinely strange and worth taking seriously. Scenario 1, the most likely outcome. Redress grows to maybe 2 to 5 million paying subscribers, generates somewhere between $200 million and $1 billion of annual revenue across the layers we talked about, gets sued 40 or 50 times in the first decade, wins most of the cases, loses a few that produce permanent operating restrictions in specific states, and settles into a stable, mid-sized public company with a defensible market position. The market it dominates is what we have been calling subclass action consumer harm. The market cap, if it makes it through the regulatory minefield, is somewhere between $5 and $20 billion. That is the base case. Not a unicorn, not a category-defining giant, a solid, defensible mid-cap company that has carved out an asset class that did not previously exist. Scenario 2. The platform gets acquired, probably by Burford Capital, possibly by LegalZoom, possibly by a private equity firm with a litigation finance arm. The acquisition price would be, depending on timing, somewhere between $200 million and $5 billion. The acquirer integrates the redress front end with their existing capital base and effectively becomes the dominant consumer litigation funder in the country. The founders cash out. The asset class continues to develop under the new owner. The strategic value to the acquirer is the data and the consumer relationship, which they could not build on their own. Scenario 3, and this is the one I want to spend time on. The platform succeeds beyond anyone's projections. It becomes, in effect, a private enforcement layer for American consumer protection. It does what the FTC and the state attorneys general were supposed to do, but never had the resources or the political will to do. It generates billions of dollars of recoveries for harmed consumers. It restructures the behavior of an entire stratum of small businesses. And in doing so, it accumulates a kind of quasi-governmental authority that nobody in the founding team probably ever wanted to have. Here is the inversion I want to leave you with. If redress works at the scale it could work, it stops being a startup and starts being a regulator. Not legally. Operationally, the decisions about which businesses get investigated, which complaints get aggregated, which dossiers get published, which cases get prosecuted are, in aggregate, the kind of decisions we have historically expected governments to make. And the platform, by virtue of having built the only mechanism that can make those decisions at scale, ends up making them by default, which is the kind of role that, historically, raises questions about accountability, transparency, due process, and the distribution of power that are not obviously well suited to a venture-backed company answerable to its shareholders. Let me be more specific. The Federal Trade Commission, for all its limitations, operates under the Administrative Procedure Act. It has rulemaking processes. It has notice and comment requirements. It has appellate review. Its decisions are constrained by due process. A private platform that makes equivalent enforcement decisions has none of these constraints. The chief executive decides which businesses to target. The general counsel decides which cases to drop. The board decides which markets to enter. None of those decisions are subject to the kind of public oversight we expect for analogous government decisions, which means if redress scales to enforcement scale, we will have, accidentally, created a parallel regulatory regime that operates under corporate governance rules rather than administrative law. And nobody, as far as I can tell, has thought hard about whether that is a system we want. I want to be careful with this. I'm not opposed to private enforcement. I think the architecture of consequence-free small harm is a worse problem than the architecture of accountable but imperfect private enforcement. I would rather have redress than what we have now. I want to be honest about the fact that the second-order outcome is not what the founders are explicitly building toward. They are building a startup. They will, in the natural course of things, end up building a regulator. And the gap between what they think they're doing and what they will end up doing is, in my view, the most important thing nobody's talking about. A digression that I think matters. There is a particular kind of company that gets built when somebody identifies a market failure that government has not addressed and constructs a private mechanism to address it. Standard & Poor's was, in its origin, a private mechanism for addressing the market failure in corporate credit information. Underwriters Laboratories was a private mechanism for product safety certification. Moody's was the bond rating equivalent. Each of these companies started as a startup and ended up as a quasi-regulator. Each of them now has, embedded in the structure of American capital markets, an authority that is in some sense more powerful than the government agencies that ostensibly regulate them. The founders did not plan it that way. The market dynamics produced it. Redress is, I believe, in the early stages of becoming that kind of company, which means the people studying it should be studying it not as a startup, but as the next instance of a recurring pattern in American institutional development. The political coalition. If redress succeeds, two political coalitions will form. The defenders will be a strange alliance of progressive consumer protection advocates who like the outcome, libertarian populist activists who like the bypass of government, and the plaintiff's bar that gets the revenue. The opponents will be the Chamber of Commerce, the National Federation of Independent Business, the state bar associations, and various trade associations whose members are being targeted. The defense coalition is, structurally, fragile because its members agree on the outcome but not on the philosophy. The opposition coalition is, structurally, durable because its members all agree on the philosophy, which means the political dynamics over time favor the opposition, which means redress, even if it succeeds in the market, will face increasing political pressure as it scales, which is why every founder of a company like this needs to be a political operator as well as a product builder, and most of them are not, a self-contradiction. Earlier I said the platform's strongest defense is constitutional. I want to complicate that. Constitutional defenses work in courts. They do not work in legislatures. And the long-run pressure on a platform like this is going to come from legislatures, not courts, which means the constitutional moat protects the platform in legal fights, but not in political fights. And political fights, over time, reshape the legal landscape in which the constitutional moat operates. The end state, if the platform is durably successful, is that legislatures pass laws specifically designed to constrain it, and the platform spends increasing energy litigating those laws. At some point, the legal costs become a structural drag on the business, and the platform either gives up on certain markets or transforms itself into a different kind of entity the legal environment can accept. 3 years ago, I had a long dinner with somebody who has spent his career at the intersection of regulatory policy and venture capital. I will not name him. He told me the most important question for any company in a quasi-regulated space is not how to comply with the rules, but how to shape them. The companies that win in these spaces are already in the room with the legislators who will write the rules before the rules are written. That requires a particular kind of founder, a particular kind of capital, and the discipline to spend money on political infrastructure when the financial logic says spend it on product. I think about that conversation when I think about redress. The founders, in my limited exposure, are product people, not political people, which is not a criticism. It is an observation about where the binding constraint will bite. Let me close by going back to the tow truck. The car gets dragged out of the lot at 3 a.m. The driver's angry. The driver writes a review. In the world we currently live in, the review evaporates into the void. In the world redress is trying to build, the review becomes a share certificate in a holding company whose only asset is a partially formed lawsuit. The lawsuit, if it succeeds, generates a payout. The payout is the difference between consequence-free harm and accountable harm. And the asset class that contains all of those holding companies, all of those share certificates, all of those distributed claims, is something that does not yet have a name, does not yet have a price, and does not yet have a regulator that knows what to do with it. Somebody is going to build it, whether it is redress or somebody else. The substrate is real, the capital is waiting, the technology is sufficient, the legal infrastructure is, just barely, permissive enough. This is the kind of moment, structurally, that the financial historians of 50 years from now will look back on and ask why nobody saw it coming. And the answer is that some people saw it coming. They just did not write papers about it. They were too busy positioning themselves for what comes next. That is the room you are now in. The conversations after this point are conversations you should have on your own.